All right, so let's get started with chapter 3. And the name of this chapter is the adjusting process. So before we get started with all of this, I want you to remember, a couple of things. We are dealing with what is called the accrual basis of accounting. And and what that means essentially is that we recognize revenues when they're earned and we recognize expenses as they are incurred. So I want you to think a moment about your own personal life, and I want you to pretend that you are a business, okay? And as ludicrous as this may sound, it may help you. If it doesn't help you, that's okay. We've got some other material. But I want you to think about your car insurance. And let's say that you pay your car insurance every 6 months, right? And let's also say that, just to make it simple, let's say that you pay $100 per month. So when you pay that bill, you're going to be paying $600. And that is essentially $100 per month times 6 months. Okay. And let's say that your premium was due on November the 1st. Make this as easy as I possibly can. And let's also say that your business that we're pretending that you have is a calendar year business, meaning you measure your revenues and your expenses from January 1 through December 31. Well, even though you have paid $600, when you do that, you have a $600 asset. But even though you've paid out $600, you do not have, in the accrual accounting world, a $600 expense. Your expense is $100 a month times 2. Okay? $100 a month times 2. That would be for November and for December. Okay, we expense that as we use the asset up rather than expense that when we pay it. If we expense everything when we pay it, we call that the cash basis of accounting. And that's what small businesses use. And that's what you use in your personal life. But I want you to kind of pretend that, as we go through this chapter, use some examples in your personal life, and understand that with the accrual basis of accounting, you may pay $600. When you do that, you have a $600 asset. It would be prepaid car insurance, okay? And then you would expense that $100 a month over the next 6 months until your prepaid asset is gone. All right, so let's get started and just stay with me. This is one of the more difficult chapters. Chapters 2, 3, and 4 are probably, in my view, the most difficult chapters that we're going to cover in this class. So do try to hang in there if you are struggling. We've got some learning objectives here. We are going to go over all of these. There are a lot of slides in this particular chapter that we're not going to have video commentary for, because they're just there are some summary slides of some of the transactions that we're going to discuss. So we'll try to make it through this chapter as quickly and as painlessly as possible. But here on the screen right now, we do have, we're going to talk about adjusting entries for accruals, deferrals. We're going to introduce the idea of depreciation, and we're going to ultimately prepare an adjusted trial balance. Now, we've already prepared an unadjusted trial balance, but as we're going to find out as the end of the year, end of the month, whatever the case may be, occurs, with accrual accounting, there are adjustments that have to be made, and they're not a lot of fun. So again, hang in there. Okay, so we've discussed this already. in chapters 1 and chapters 2. But we'll go ahead and we'll do some review, and I hope that to a large extent this chapter and this discussion is a bit of review for you. But we need to discuss the accrual versus the cash basis of accounting. And it says under the accrual basis of accounting, revenues are reported on the income statement in the period in which a service has been performed or a product has been delivered. Says cash may or may not be received from the customers during this period. And we had an example of that with our Net Solutions example. Our first revenue transaction, they provided $7,500 worth of service. And so they would recognize that revenue when they provided the service. They also received the $7,500. So in that particular case, cash was received. But they would have still recognized that revenue even if the customer didn't pay them up front under the accrual basis of accounting because the revenue had been earned. And we do the same thing. The accrual basis of accounting also requires expenses to be recorded when they are incurred, not necessarily when cash is paid. So I gave you 2 examples of that. Or I gave you 1 example, but we could look at it a couple of different ways. We used the car insurance example. And the first example was we're paying the $600 up front. And then just because we paid that, we haven't actually incurred 6 months of expense yet. In fact, when we first pay the bill, we haven't incurred any month's expense. Okay, so we have no expense. We have a prepaid asset, prepaid insurance. And then as 1 month ticks by, we can in our example, it was $100 a month. We would recognize an expense because that's when the actual expense is incurred with the passage of time as it works with insurance. We could also say that, let's say that we got the insurance policy for 6 months, but we weren't billed for that, let's just say for another 2.5 months. Okay, maybe we changed our policy or something like that, and we called into the insurance company, and they said, well, you normally pay your bill on January the 16th, so we're going to send you a statement for these 6 months. And so you actually don't pay the bill until the early part of the next year. Well, you got the insurance coverage November the 1st in our example. So even though you haven't paid until January the 16th of the following year, you would still have $200 expense recognized in the prior year for November and for December. Okay, so 2 examples, and we're going to get into some vocabulary on how that works here in a little bit. Let's see, where are we at? Okay. Got ahead of myself there. Okay, slide 4. GAAP and the accrual basis of accounting. You may wonder, why don't we just do everything based upon the cash basis of accounting? It would certainly be a lot easier. Well, if we are a large company in particular, generally accepted accounting principles forbid the use of cash basis accounting and require the accrual basis of accounting. One quick note, this has nothing to do with income taxes. Okay, so if any of you have a small business and you say, well, that's not how I pay my income taxes and I have a good CPA and blah, 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 income taxes, completely different animal, all right? Okay, so I do want to say that, when we're talking about the cash basis of accounting, I do want you to understand that most small businesses use the cash basis of accounting. Most accounting firms use the cash basis of accounting. Legal lawyers, legal firms often use the cash basis of accounting because their receivables are so much in flux. and they really don't know what money they're going to get and what money they're not going to get. So there are a lot of businesses that use the cash basis of accounting. But when we talk about financial accounting in this class, we are talking about primarily companies that are selling stock to the public, and those companies are not allowed to use the cash basis of accounting. So again, when it comes to revenue and expense recognition, it says under the revenue recognition principle, revenues are recorded when services have been performed or when products have been delivered. The process of recognizing revenues is called revenue recognition. Again, the payment of actual cash does not have to occur. Now, if we recognize that revenue and we never get paid for it, we have some adjusting that we're going to have to do. But when the services have been performed or when the products have been delivered, that's when we recognize revenue, not necessarily when we receive the actual cash. So here we have a little accrual accounting versus cash basis accounting exercise. And this is actually something that for the on-ground students, they will have to do something very, very similar to this on paper in class. And we've got this fella here. Looks like he is, looks like a squeegee there. So he looks like he's washing windows. And let's see, what do we have here? Washing windows in January. Okay, interesting. So we have a situation here where we have a job that was performed in January for $20. And this fellow was paid this $20 in the month of February. And that's for this house right here. For this house, he also did the work in January, and he was paid $25 in January. And then for this third blue house here, we have a job done in January for $15, and he was paid in February. So what I want you to recognize here is that the work was done, the revenue was earned in January for each of these three jobs, okay? Says under accrual basis accounting, his income for January is $60, and for February, it doesn't have anything here, but it's zero. 20 plus 25 is 45, plus 15 is 60. So because the revenue was earned in January, he will recognize under the accrual basis of accounting, he will recognize all $60 in January, nothing in February. In fact, he wasn't even around in February because he went on vacation. Because who doesn't go sailboating or whatever in February? However, under the cash basis of accounting, it's a lot different. He was only paid for this second job in the month of January, so his January cash basis income is $25. However, his February cash basis income is $35. That's the $20 here that he was paid in February, and then this $15 here that he was paid. Okay, so if we were in this class, we would say, what is his, if I just asked you and I didn't specify accrual or cash basis, and I just said what was his income in January and what was his income in February, your answer needs to be $60 in January and $0 in February, not this business over here, okay? All right, let's go ahead and wrap this video up, and we'll get another one started immediately.